Welcome to the deep dive. Today, we are strapping in for a forensic analysis of a recent earnings call transcript. We've got the numbers from a major financial institution.
You do.
And this document, it's not just about looking backward, it's really a detailed strategic map for how this institution plans to tackle 2026.
That's right. Our mission here is to look beneath the surface. We're interested in the intentionality of their strategy. How are they aggressively funding core growth?
Especially in some of these high-margin areas.
Exactly. In specialized lending, while at the same time, they're executing one of the most intense efficiency drives in the industry. It's a kind of financial engineering, and the sources really give us the blueprint.
They really do. Okay, so let's start with those top-line numbers for Q4 2025 because, on the surface, they look fantastic.
They look great.
We're talking $5.4 billion earned, which is up 6% year over year. Diluted earnings per share, or EPS, that hit $1.62, up 13%. Strong growth. But here is the critical piece of context you need right away. Management took a pretty significant and very deliberate financial hit in Q4.
They absolutely did.
Yeah.
Q4 included a $612 million severance expense. Now, that number, it sounds huge, but the institution was really explicit about this.
Right.
This was largely reserved for streamlining and, efficiency actions they plan to carry out through all of 2026.
So it's a calculated, self-inflicted wound, isn't it?
Precisely. I mean, if you adjust for that one-time charge, the diluted EPS jumps all the way up to $1.76. Management is basically saying, look, we are willing to take a massive upfront punch to our Q4 results.
Because we know it's going to create more savings and capacity next year.
Exactly. It just demonstrates an extremely aggressive commitment to their long-term efficiency goal. They're signaling that every future dollar of savings is being hard-won right now.
And that leads us right into where this efficiency focus has been driving results. I mean, the sources just repeatedly highlight this commitment to continuously streamlining operations.
Yeah, and it's not just talk. We've seen them reduce headcount every single quarter since Q3 2020. That's a serious, sustained trend.
It is.
And what's fascinating is how that dedication to efficiency underpins their core banking performance, specifically net interest income, or NII.
Which is essentially the profit margin banks make on their lending activities.
Exactly. And NII increased 3% just from Q3 to Q4.
That quarterly increase, what they call linked quarter growth, that shows real momentum.
It does. And if you strip out the more volatile results from their market segment, NII still increased by a substantial $167 million. That underlying strength came from a positive mix of factors, higher core loan and deposit balances and favorable repricing of their fixed assets.
So they're getting more profitable with the money they already have.
In a nutshell, yes. And they're growing the balance sheet at the same time. The lending environment is a really strong link for them right now. Loan growth was 5% in Q4.
And they noted this was the strongest linked quarter growth since before the pandemic disruption back in Q1 2020.
Which suggests a real resurgence in very targeted lending. It wasn't just generalized lending either. The vast majority of that average loan growth, it was driven by commercial and industrial loans, or C&I.
Concentrated in their corporate investment banking and commercial banking arms?
Right. So this suggests they are lending directly into things like business expansion, equipment financing, and the working capital needs of large corporations. It's high-quality, targeted commercial activity.
And, just as impressive is their liability management. This is where you really see their market power shine. Average deposits increased by nearly $24 billion year over year.
And that inflow came from consumer and commercial accounts, which successfully offset declines in those higher-cost corporate treasury deposits.
Wait, let's pause on the cost of those deposits. This is a huge sign of strength.
It really is. They reduced the average cost of deposits by a striking 29 basis points year over year.
That's market power right there. They are pulling in more money from stickier, cheaper sources like your checking account and business operating accounts and paying less for it overall.
That differential is a significant driver of their future NII health. It really speaks volumes about the stickiness of their client base and their ability to manage interest rate sensitivity on the deposit side.
Okay, but to understand the true engine of their commercial growth, we have to transition now. We need to talk about a segment that is becoming so critical, they're giving us unprecedented detail on it.
Right. We're moving into the deep dive on specialty lending, specifically lending to other financial institutions.
Which sounds incredibly dense and complex. But the sources are actually laying out exactly how they manage the risk. And this category is a major engine for their commercial loan growth.
Absolutely. Historically, this type of detail would be buried deep in a 10Q or a 10K footnote. but the growth here just necessitates transparency
So it's broadly lending to financial institutions, but it's broken down.
into four distinct, carefully managed pillars.
Okay, so walk us through the structure. I'm especially interested in how they neutralize the risk in each one.
The first and largest pillar is asset managers and funds. This is their biggest growth driver. We're talking about fund finance and capital call facilities for alternative asset managers.
So think major hedge funds or private equity firms.
Exactly.
And for the listener, what exactly is a capital call facility?
It's essentially a short-term revolving line of credit that's extended to a private equity fund. So when the fund wants to buy a company, they need cash immediately. They use this line of credit.
And then they get the money later from their investors.
Right. Later, the general partner issues a capital call to their limited partners, the big pension funds or endowments who promised the money in the first place. So the loan is collateralized by those future promises of capital.
And because those LPs are typically large, diversified investment-grade institutions, the bank sees the risk as very low.
Precisely. The structure is very secure.
Okay, that makes sense. What about the second pillar?
That's commercial finance. This is secured lending to private equity funds and asset managers. But the collateral is different. It's typically backed by pools of existing middle market or broadly syndicated loans.
And the key risk management feature here.
The critical thing here is that the bank monitors the performance of each underlying loan in that collateral pool individually.
So they aren't just trusting the pool, they're effectively underwriting the collateral itself. That must require significant staffing and expertise.
It requires a high level of specialized talent, yes. And that's part of the high margin trade-off. They're getting paid for that deep underwriting expertise. The third pillar is the smallest, consumer finance.
Where they lend to clients involved in things like credit card issuance or auto lending.
Right. Again, secured, but to specialist finance companies. And the fourth pillar is the one that always raises eyebrows, real estate finance.
Correct. This includes secured lending to mortgage REITs and PE funds, often for originating or buying commercial real estate mortgage loans.
And also secured lending that's backed by agency residential mortgage loans and residential mortgage-backed securities, or RMBS.
That sounds inherently risky, especially given the current state of commercial property. Why do they still see this as an attractive risk-return proposition?
It all comes down to the security structure. For all four of these categories, the institution is explicitly stating that these are generally secured loans. They incorporate structural credit enhancements, collateral eligibility requirements, and collateral advance rates.
And advance rates being the percentage of the collateral value they're actually willing to lend against, correct?
Exactly. They might be lending, say, 50 or 60% of the collateral's value, leaving a huge cushion. By building in all those structural protections, they're engineering these complex, high-margin loans to have an ultimate risk profile that they see as equivalent to investment grade.
The message is, we're taking complex risk, but we're being paid handsomely to manage it down to a safe level.
That's the idea.
That provides great context on their lending engine. So now let's talk about revenue outside of interest. Moving to non-interest income, we saw a 5% increase year over year.
Yeah, and that was heavily driven by fee-based revenue. It's that positive flywheel effect we often discuss.
Investment advisory fees and brokerage commissions, their largest fee category, grew 8%.
And that growth is directly tied to market performance. When equity markets are up, the market valuation of the assets they manage in their wealth and investment management or WIM segment rises, and so do their fees.
Which means the market environment is crucial to their non-interest revenue growth. Okay, let's pivot back to expenses. We know they planned for that massive severance, but what was the final Q4 expense picture?
Well, non-interest expense actually declined $174 million year over year. That decline was achieved through those efficiency initiatives, plus lower FDIC assessment expenses and lower operating losses. So that's the good news.
But I'm sensing a but.
The offset. They are saving, but they're also spending aggressively. Those savings were partially offset by higher revenue-related compensation in WIM.
Which, again, is due to the strong market performance.
Exactly. And they also increased advertising and significantly ramped up technology investment. It's a clean signal. Operational savings are immediately being recycled into growth and modernization.
And shifting to credit health, did they sacrifice quality for all that growth we saw in specialty lending?
Credit quality remains strong overall. The net loan charge-off ratio actually declined 10 basis points year over year.
That's good to hear.
That said, there was a specific and very much anticipated pain point: Commercial real estate losses, predominantly in the office portfolio, did increase charge-offs.
That seems unavoidable across the entire industry right now. What was their tone on the CRE office expenditure?
They were very specific that while losses are up, they expect office valuations to stabilize soon, and they have already anticipated these issues. They believe expected additional losses should be, and I'm quoting here, well within expectations.
So it suggests they feel they have reserved appropriately and really understand the scope of the problem.
It does. And, crucially, they ended the year with a rock-solid capital position. They repurchased $5 billion of common stock in Q4, which signals high confidence. Their CET1 ratio, a key measure of capital strength, was 10.6%.
Comfortably above the 8.5% regulatory minimum plus their buffers.
Very comfortable.
Okay, that covers the rearview mirror. Now, let's look ahead to 2026. This is maybe the most strategic section of the entire call. We need to dissect their financial forecasts, starting with net interest income.
Their NII forecast really shows confidence. They reported $47.5 billion in total NII for 2025. For 2026, they are guiding for total NII of $50 billion plus or minus.
And if we look at the core business, NII excluding their market segment.
They expect that to grow from $46.7 billion to approximately $48 billion.
And they're being more transparent about the market segment NII now too, right?
Yes. They anticipate markets NII will grow to about $2 billion. And this is driven by two things. First, lower short-term funding costs, which helps the markets division's balance sheet. And second, an increase in client financing activities.
That client financing activity sounds like lower margin, higher volume business.
It is lower margin and lower risk, but it's additive to NII. However, and this is important, they provided a counterpoint. They expect this NII growth in the market segment to be partially offset by lower non-interest income in that very same segment.
So they're essentially trading one type of revenue for another within their capital markets division just to maximize that NII line item.
That's a good way to put it.
And none of these forecasts happen in a vacuum. What are the core economic assumptions they are betting their $50 billion NII target on?
The foundational assumption is a pivot in monetary policy. They are assuming the Federal Reserve will implement 2 to 3 rate cuts over the course of 2026.
Okay, and what about the long end of the curve?
They assume 10-year Treasury rates will remain relatively stable. That dynamic of a falling short-term rate coupled with a stable long-term rate, it creates what they call a modest headwind to NII. It makes their lending margins just a little bit tighter.
So how do they overcome that headwind to hit the $50 billion target?
Volume. Simple as that. They are expecting mid-single-digit growth in both average loans and average deposits. Loan growth is forecast across the board, commercial, auto, and credit card.
And deposits.
On the deposit side, they expect stronger growth in interest-bearing accounts versus non-interest-bearing. And importantly, this expected loan growth means their provision expense, the money they set aside for potential future losses, will increase to support the larger balance sheet.
Okay, now for the part that requires the most attention, the expense outlook for 2026. This is the ultimate tension point, given all the talk of efficiency and that huge severance charge.
It really is. They anticipate non-interest expense to be about $55.7 billion, up nearly $1 billion from $54.8 billion in 2025.
It's the great paradox. They're saving money in one pocket, but they're immediately spending more in the other.
That's it. They anticipate $2.4 billion of gross expense reductions from efficiency initiatives. Now, that's a huge number, and it justifies that upfront severance hit.
$2.4 billion in savings is massive. So where is all the money going that completely offsets those savings and pushes the total expense up?
It's the cost of growth and modernization. Those $2.4 billion in gross savings are more than offset by 3 primary spending drivers. They total about $2.7 billion.
Okay, what are they?
First, $1.1 billion is earmarked for incremental tech expense. Think infrastructure and new business capabilities. Second, $800 million goes into other investments across their businesses. And third, another $800 million increase covers mandatory structural expenses like merit and benefit increases, plus performance-based compensation.
So they're spending almost dollar for dollar what they're saving just on tech and investment.
Exactly. And then you have those other necessary increases like compensation. They also noted several specific factor shifts that impact the baseline. They will save $700 million on severance compared to 2025.
Since that cost was booked in Q4 2025.
Right. But then the regulatory cost goes up. The FDIC assessment expense is expected to increase by $400 million. That's due to anticipated deposit growth, plus they won't get a $200 million special assessment credit they had in Q4.
You add all that up and you get to that projected $55.7 billion number.
You do.
So let's synthesize this entire deep dive. We saw a Q4 that was defined by strong fee-based revenue, disciplined credit health, and a return of capital through buybacks.
And the overriding strategy for 2026 is clear. The institution is it's successfully balancing this aggressive internal efficiency, that $2.4 billion in gross savings, with significant external investment in tech and core business capabilities.
They're reshaping their structure to be leaner and more digital.
Right, and all while navigating what they expect will be an interest rate pivot from the Fed. They're betting that their volume growth, especially in those targeted commercial areas, will successfully overcome the expected interest rate headwinds.
And as we clean out this deep dive, let's leave you with one final provocative thought. It ties directly into the complexity of those 2026 projections. The expense outlook includes a significant projected increase in revenue-related compensation expenses, specifically within the wealth and investment management segment.
Which is tied to market performance.
Exactly. The call transcript makes it clear that this specific compensation increase is tied directly to the assumption that the S&P 500 will be up modestly throughout 2026. So what happens to that incredibly complex $55.7 billion expense forecast if the market performance diverges significantly from that single key assumption?
If the S&P has a major downturn, or conversely, a massive explosion upward.
Right. It raises an important question about the fluidity and the contingency planning behind their 2026 expense projections that wasn't fully addressed in the call, something for you to mull over as you track their progress this year.